Okay, good morning, everybody. I apologize about class today not being able to come in. Um, I'm running on almost no sleep this morning, so we're going to get through this. I'm going to try and go through it pretty quickly. Really, no extra anything. Also, I'm just working on my laptop. I don't have my other screens here with me, and so. We're gonna keep it. Actually, you know what? I'll drop this thing up. I'll hide that, and so it'll make the should. Well, I thought that what am I not clicking right? There we go. All right. That way I can see my slides to click through. Um, but also should be big enough on your screens. All right. So let's run through this today. Um, I really wanted to get through this one because I do think that there's some important stuff here. We're dealing with ratio analysis, and specifically, we're going to be talking about profitability and efficiency. And so those two things are we have ways that we measure them that analysts use, that creditors use, that lots of people use, and we'll talk about each one, but they help us get an understanding of how well a business is running. So let's see. All right. So ratios are used to simplify complex financial data. But basically, you know, ratios give us one number that we can use as a comparative tool. And you can take a whole bunch of stuff and condense it to, one ratio. And it really does tell us a lot because we've figured out how these ratios work and how to calculate them. And so it really can give us a lot of information. Um, One of the biggest things it allows us to do is it allows us to make comparisons. And that can be, within the company, like comparing to historical data. It can be comparing to peers or industry wide. And peers and industry wide aren't necessarily the same thing. You may consider your peers to be companies that are in your industry, but that are also more around your same size, your same, everything like that, versus uh, the industry wide is going to be everyone, like everyone in the industry, no matter the size. So, in addition to that, um, basically, whenever we get down to it, we use these different ratios that we calculate to look. It's almost like a SWOT analysis. I was thinking whenever I put the strength, weaknesses, and potential opportunities, the only thing I didn't add was threats. But that's really not what I was getting at. I was trying to get to, um, we can see where companies are operating, very well, or they're operating from a strong position, but also if they have a potential problem, if they have a particular ratio that's always sort of worse than industry or peer or whatever, we can see those. And then also those weaknesses are often the same places where we have opportunities because we can try to improve upon that. We've identified it as an area we need to improve upon, and so we can therefore do that. um, Ratios are not ever going to be enough in and of themselves to make it, a full blown decision on anything, but they're a good starting place. And as long as we understand what they are and we understand, how we're meant to use them and we're using them in conjunction with other information, then we can make, a good, a good decision about whatever it is that we're looking at. All right. So there it goes. All right. I want to talk about the profitability ratios first. And so, profitability ratios, as the name suggests, is talking about how well, I used effective here, how effective a firm is at generating profits. Okay, how well are they conducting their business and making money? And we're going to focus on three areas: sales, assets, and equity. All three of those areas have ratios specifically around them that will help us understand how well a firm is generating profits. And it's these five here. We're going to go through each one of them uh, in the next couple slides. So let's look here. Well, one slide each. All right, gross profit margin. Remember, gross profit is sales less cost of sales or cost of goods sold. Okay, although I use those terms interchangeably. So gross profit over revenue is our gross profit margin. Okay, so what this is trying to tell us is how efficiently do our sales directly convert to gross profit. Um, and if you let's see, also it measures the operating cost control effectiveness. And these are the direct operating costs again in the cost of sales, not like SG&A and the other stuff. So what does that mean? Basically, it tells us, how much of our sales are left over after those operating or cost of goods sold costs. Okay. If you think about it, there's really only generally three numbers that we're looking at. We're looking at sales, cost of sales, and gross profit. So if the gross profit is getting bigger, then either sales are getting bigger and cost of sales are staying the same, or sales are staying the same and cost of sales is going down. Either way, somehow uh, the gross profit is increasing. The only way for it to increase is for revenue to go up or for cost of sales to go down. So that's what we're looking at. And we want to see higher gross profit margins, generally just because we would consider that to be good. Now, keep in mind that that is very industry specific. Um, an industry that historically runs lower margins, just in general, um, because they're very, cost centric. It just whatever it is, it costs a lot to do what they do. Um, what is a high gross profit margin for them might be extremely low for something that's for another industry, like say the tech industry, where gross profit margins are often very, very high. So it's very industry specific, but whenever we're doing comparisons, within the industry or our peers, we want to see or be towards the higher end of that spectrum. All right, operating profit margin. So this one is different from gross profit because it also takes into consideration like those selling, general, and administrative expenses, and any other operating expenses except for interest and taxes. We're going to take interest and taxes out of this, so the EBIT, and that we're going to put over revenue. Or I think I changed. Okay, I had revenue there too. I thought maybe I had net sales. Um, Same thing. Revenue and net sales are the same thing. But so the operating profit is sort of that core business. It doesn't just look at that cost of sales, but it also looks at sort of that overhead, the accounting departments and the executive departments and all those supporting departments, that are there in order for the operations to exist. It's taking those into consideration too. So it's going to measure the efficiency of all of that. Um, so it excludes interest and taxes, uh, in part or a big part because those are we're looking at those are non-negotiable. Like those are based on rates that are set in either, they're related to the debt or they're rates set by the IRS. We're not really focused on those with this particular measure, um, because that they should be within the same ballpark for most everyone and shouldn't have a ton of fluctuations. uh, across companies, especially in the same industries. All right. Now, lastly, net profit margin, as you can imagine, is just the net income. So that is everything. Take everything down, and basically out of everything that our firm is doing, you know, how much of our revenues were we able to convert into, that bottom line number to get that bottom line performance. So again, it's going to include everything, even that interest, that taxes, everything, to give us an idea of, how on a whole the company performed. Return on assets. Um, so there, if you think about it, return on assets, net income over average total assets, average being 1231 last year, 1231 this year, average them together, divide by two. Um, the idea is that we use our assets to run our operations. Like that's the reason we have assets is so that we have operations, and those operations um, result in the returns that we see. And so this return on assets is we're trying to get an idea of, how great of a return are we earning based on all the assets that we have sort of collected. And that's going to be our fixed assets. Of course, things like inventory and stuff, we know that that's already going to be baked into that. But whenever we look at it holistically, at sort of every component of the assets of the firm structure, um, we can see how all those things combined are driving net income and that return that comes back to the company um, every year. So average total assets, yeah, average of the whole year, and yeah, are our assets being used to their full potential, basically? If we're using benchmarking and our ROA is a lot lower than our peers or the industry, then we're probably not, being effective somewhere. Like what are we doing that everyone else is doing better than we are? Okay. Return on equity. Um, so return on equity, same measure net income, but this time we're using shareholder equity instead of assets. And this is specifically, we're looking at this because we're trying to determine, based on our capital structure and what our shareholders uh, have, how much return are we generating for them? And I put here, remember that net income gets closed out to retained earnings. So there's that journal entry at the end of the year that basically picks net income up and drops it into retained earnings, which is, retained earnings is, I don't know the formal definition, but it's basically the collection of, accumulated net income over the life of the company that's then, adjust for, uh, different happenings in different years or whatever. But generally, that's what it is. That's what it's considered to be, is the remnants uh, of the net income that's left over. Things like dividends and stuff like that, paying back the shareholders is going to eat into that retained earnings because that's what it's there for. It's meant to be used to pay out, to the owners of the company. So it's pretty straightforward, honestly. All right, maybe too much. No. Okay, so efficiency ratios. How efficiently does a company manage and utilize their assets to drive income? These are different from the profit margin, the profitability ones, because all of these ratios include both an income statement line and a balance sheet line. One or the other, numerator or denominator. Um, and they're going to tell us basically how efficient we are at performing some task. And a lot of these tasks are going to be those cash conversion tasks that we were talking about, receivables, payables, inventory. That's predominantly what we're talking about. Okay, let me go on. So the first one here is going to be the asset turnover ratio. So with the asset turnover ratio, we're looking at first our sales. This is where I've switched from revenues to sales. Again, same thing. Um, but we're looking at that sales number, which is our income statement, over our average total assets. Um, and average total assets again, beginning of year, ending. All right. So what is it? Um, oh wait, I think I went one. Did I go one too far? I thought I had return on assets before this. Huh. I apologize, guys. I must have copied over return on assets. So okay, similar to return on assets, instead of just using the net income uh in this ratio, instead of using just the net income, we look at gross sales. Um, so obviously I skipped over the ROA, which is I think it was the first item on my no. All right, I've confused myself here. Where oh return oh I told you guys I'm tired. Return on assets. Okay, so return on assets was here, where we're looking at net income over total assets. Down here, whenever we're looking at the turnover ratio, um, we're just looking at it from the net income perspective. So, our assets are obviously we're using them to turn it into sales and ratios and stuff, but the assets that we have also affect the expenses. So, for instance, inventory, that's our cost of goods sold generally comes from inventory, things like that. So, what the asset turnover ratio does is um, basically takes those same sales or revenues, divides it by the average of the total assets, um, and it's going to tell us sort of um, how many times or what percentage of those total assets are we able to convert into sales in any given year. Now, again, that's sort of a theoretical thing because it's not like we're picking up and selling everything we have, property, plant, equipment, all that. No, obviously we're just selling inventory, but the idea is generally, once again, to see, how quickly are you able to turn over enough revenue or enough sales to effectively, convert all the assets that you've bought to put into place to run the business. Okay. All right. Inventory turnover. Inventory turnover can be important because it's telling us how frequently a company is selling all of their inventory. I think that I told you guys, I think it was this class, that I had done a thing with Philip Morris that was very interesting, Philip Morris International, that their inventory turnover ratio um, was basically so long that basically their inventory turned over like once every like 1.25 years. Like it took over a quarter or it took over a year for them to sell uh, all of their inventory that they had on hand at any given time. I'm not sure, they don't really discuss that, and it's been that way forever. So that's just sort of how their business model runs. But generally, you're going to see multiple turns per year, and that can be, again, that's another number that can be changing. If it's starting to slow down or get smaller, that means we're not turning over inventory quite as quickly, and then we need to figure out, talking about like weaknesses and opportunities, need to figure out why it's not turning over uh as quickly. Now, days in inventory outstanding is basically the exact opposite. You flip the ratio, and then we're multiplying it by the 365 days because that's going to give you a percentage. And then we want to know exactly how many days it is, if it's 10 days, if it's 15 days. Um, and so it's basically showing us the same thing. If you were to take 365 and divide it by the inventory turnover ratio, it would give you the same number that this calculates. So they're inverses of each other. One is giving you the number of times it changes, the other is giving you the number of days. Either one can be used for different planning purposes or different analysis purposes, just depending on what it is you're trying to accomplish. Um, okay. AR turnover. So net credit sales over average AR. So how quickly are those customers paying their balances? Now listen, I put this on here because I want to make sure I called out. You notice it's only the credit sales. If your company also takes cash sales, that obviously should not factor into the accounts receivable turnover because there was never any accounts receivable. It should only be sales that were made on credit. Um, but it is part of the cash conversion cycle because we want to, if we want to shorten that conversion cycle, then we can be more aggressive and try to get that money collected more quickly, thereby getting the cash more quickly. Day sales outstanding, similar to how the inventory and days inventory outstanding is just the flip, the inverse of the previous one, the accounts receivable, net credit sales over average AR over net credit sales times the days. So once again, we're going to get a ratio and then we're going to multiply by 365 to figure out how many average days it is before we completely collect all of our outstanding accounts receivable. Um, you know, doesn't necessarily mean that we're going to sell every single item we have that quickly. No, but it gives us a good idea of how quickly we're doing. Okay, and so the last one of our sort of cash conversion method measures that we talked about that we need to run through relates to accounts payable. That was the last one, and uh, with this again, we're looking to see um, how like what the time frame is on us, sending that cash back out. In our example with General Mills, they had a very long accounts payable turnover, and that directly, relates to having extended um, terms with like your suppliers, and that can be good because basically it lets you keep that money, that cash, in your pocket longer, in your accounts longer, um, and that's just a good way to lengthen that cash conversion cycle, right? Or no, it would shorten it because you're holding on to it. You want it to be shorter. Um, just like all the others, the opposite of that is the days payable. Again, you're just flipping the accounts. Oh, I didn't change the formula. I was obviously duplicating tabs, so it should be average accounts payable over cost of sales. So sorry about that. Let's do average average accounts payable over cost of sales. Sorry about that. Um, so, what does that mean? How, just what we were talking about, how quickly? So it's assigning a day's value to the ratio we already have. So we know exactly how many days they are. And do you always need to know the days and stuff? No, not necessarily. It's just it can be useful. Again, a lot of this comes back to benchmarking and making comparisons. That's why we do the ratios, is for that kind of, analysis with the benchmarking and historical analysis and peer analysis. that's why we're doing those things. And so, being able to have a couple of different ways to look at stuff um, just makes sense a lot of times. So why, and that goes into, why do we use it? The sort of three things I called out, investment. So with this, I'm thinking, either like analysts, or if you or like someone in like a treasury function or something like that, where they're looking at investments for a company. It Doing this kind of analysis allows you, if you have X dollars that you want to invest, then these are some of the ratios that you would want to use in your analysis uh, whenever you're comparing different companies to try and figure out, go back to that sort of strengths, weaknesses, opportunities type stuff, figuring out which companies are in the best position um, to invest in. Uh, Credit assessment, that could be a couple different things. Normally, we think of credit. A lot of times, I immediately think of like banks and debt notes and stuff. But it could also be vendors. You're a customer of theirs, and so they have to confirm, your credit status uh, before they'll accept you as a customer. Well, they may be doing this kind of analysis too to make sure that, if your days payable outstanding is 200, then that means you're only paying, once every 7 or 8 months, 7 months. Um, so a company might not want to work with you. So just things like that would go into the analysis um, whenever they're trying to make that credit decision. And then the last is just sort of setting a benchmark for yourself that you can look to, going forward. Like this is where we're at, and you can see how your company is progressing year after year. There are many limitations on using ratios. They are, well, just like with financial statements and a lot of things that accountants do. They're backward facing. They are looking at historical data. Now, with that in mind, I do say here, the analysts and stuff may estimate where they expect ratios to come out. I mean, that's what earnings per share is the estimation of a ratio of earnings over shares. So, that's the same concept, but there can be some estimation, but from a practical like accounting perspective, it doesn't really do anything. If you are, looking to proactively invest or do something like that, then yes, it makes sense. But for just general analysis, looking to the future doesn't really do anything for us. Um, you have to look oftentimes very specifically at the industries that you're looking at. And the examples I used here, retail chains expect high quantities of turnover with their inventory. They're expecting to constantly be selling stuff because that's their business. Um, so they want to turn things over more quickly. They also don't have all those big set property, plant, and equipment costs, other than maybe like brick and mortar stores and stuff like that. They don't have all those other assets that's tied up into their operations, into the, other than having the buildings. It's not like Walmart needs a bulldozer in order to, sell toothpaste. Just isn't necessary. So for retail, they're really focused on um, inventory turnover, while a big manufacturing, someone that does have, lots of machinery in the plant and all these things, they're going to focus more on total assets because they need all of those other PP&E assets in order to operate the business. That's what they need them for. And so they're going to be more focused that way. So you have to be careful comparing between industries because you really could very easily end up with apples and oranges. You just can. Um, and then different accounting methods. There's some areas that you'd want to make sure of, like uh, inventory methodology, LIFO versus FIFO. So if you're trying to compare two companies and one of them uses LIFO and one of them uses FIFO, well, you would need to um, calculate the FIFO return or the FIFO reserve or whatever um, for the company that had the LIFO in order to make them apples to apples. There's other things that you may not even know because it may not be disclosed, but like their policies towards like bad debts, their allowance for doubtful accounts that can affect receivables and stuff. Those policies can vary widely. You would think in an industry they'd be pretty much the same, and they might be for the most part, but there's still that chance that you could have some pretty significant differences. Um, and that's something that's hard to see. LIFO and FIFO, they have to tell you that it's there. For something like the AR reserve, they don't. So that doesn't, there's not much that we can do about that. But it could be a possible explanation if we see a difference that we didn't expect. So okay, got through that pretty quickly. Um, I do think it's important, but I wanted to run through it. Now, I quickly want to pull up. I'm not going to read the whole thing, but I do have our case study put together. I spent time this morning putting it together, and I will get it posted as I get this video posted. Um, so basically, I thought I was being clever. I'm not. I'm too old to put Forever 21 in there, but Forever 35 might be a good fallback for me. So Forever 35, popular retail clothing for consumers 30 to 50. All right, so there's some background here about how the company is done, their growth rates, all that stuff. Um, but as you can imagine, like with many other, especially mall style retail stores, they're having some problems in more recent years. And so, we're wanting to make sure that, things are still working the way they should. They're meeting their earnings per share uh, estimates and stuff, so that's good. But they have a lot of other issues that we can see. So I give you some scenarios here about how things are changing, revenues, profit margins, stuff like that. I put here your role today, and I made you an external financial analyst, is to investigate these unusual trends, decide whether they might be indicators of perhaps mistakes or potential fraudulent activity. And I always try to put potential because you can't say with resolute yes 100%, like you just don't do that. Um, so then I built this table, and you can't it's an Excel file that I copy and pasted in, so it's a picture, so you can't copy and paste it over. I apologize for that. Maybe I'll upload the Excel file too, so you can copy the values. But basically, what I want you to do is I want you to calculate some of these ratios: gross profit margin, operating profit margin, net profit margin, inventory turnover, days outstanding, days inventory outstanding. So I want you to calculate some of those. And then I want you to talk about like what trends you see, or if you see anything that's, possibly an issue. Does anything jump out at you? Um, what types of, risk or fraud or misstatements or whatever, could be causing the trends you see? Like I just want you to brainstorm a little bit and then think, what could be, uh, possible motivations, like why might management do that? And I'm going to take this out, this last one. This suggests at least two controls or odd techniques. I'm going to take that out. Because that's not, as an external analyst, that's not something we would be doing. And I put it in there and I just don't like it. So, all right, that's it. I want you to answer those in a Word document. Again, just like with everything else, page and a half, two, no more than that. You shouldn't even need that much. You should not need two pages. But if you do use up two, that's fine. Um, but just go through, draft out your answers for me. I'll get an assignment put up after I get these all loaded. I'll put in an assignment place where you can submit it. This is Thursday. I'll make it due the end of next week, and I think I still owe you guys uploading the one from Tuesday. I'll get that too. That one was a pretty easy one. I just wanted you to look at, if you recall, I just wanted you to look at a couple risk factors and talk about them a little bit from the General Mills 10K. So I'll get all that uploaded. Again, I'm sorry that I couldn't get to Morgantown today, but I am around if you need anything. Feel free to email me. The emails pop up on my phone. I get a notification so I can try and get back to you as quickly as I can if you do have a question or something. Otherwise, I'll definitely be back in class on Tuesday. I look forward to seeing everybody then, and I want everybody to have a good weekend. That is all for today. Thanks.